Hey there, fellow deep divers. Ready for another plunge into the world of finance?
Always ready.
Today, we're diving into a book that really takes us on a journey through economic history, from like ancient philosophers all the way to the dot-com bubble and even beyond.
Yeah, it's a pretty wild ride. I think this one will really help you guys understand, like, the forces that kind of shape the financial world.
The booms, the busts, the whole shebang.
Exactly.
Our guide for this deep dive is a book called Financial Games on a Balance Beam, From Debt Crisis to Financial Crisis by Ding-Yi Fan,
Great book.
published back in 2002. And it gives us this really unique perspective, I think, on how markets work and how these financial crises just seem to keep happening, like a pattern almost.
Well, and what I think is really fascinating is how relevant the book still is today, even though it was, written before smartphones, before social media, before, everything we kind of take for granted in the financial world these days.
Totally. So, I mean, that's what's so cool about this deep dive, right? We're going to be looking at how these historical events, these economic theories, can actually help us understand the crazy financial world we live in today.
Right. And we're going to be covering a lot of ground from, like you said, the ancient views on commerce to the role of central banks, the impact of globalization, liberalization, the rise of financialization.
And of course, the dot-com bubble.
Of course, got to have the
Right.
dot-com bubble, that spectacular boom and bust at the turn of the millennium.
Okay, so let's unpack this. Let's go all the way back to the beginning. The book takes us back to ancient Greece
Wow. Okay.
and the philosophies of Aristotle. Now, I gotta admit, when I think about finance, Aristotle is not the first name that comes to mind. So what does ancient Greek wisdom have to do with modern day markets?
Well, it might surprise you. Aristotle, and then later on, thinkers like Thomas Aquinas had a lot to say about commerce, about the pursuit of wealth,
Yeah.
right? They were really concerned about like excessive profit seeking, and they believed that economic activity should actually serve the common good.
Hmm.
So these ideas really kind of shaped how people thought about markets, especially back then, and how they should actually function in society.
So they believed that markets needed to be controlled, kind of like a wild horse that could get out of control if you're not careful.
Yeah, that's a great analogy. In fact, the book actually uses a really vivid historical example to make this point.
Okay, I'm intrigued.
This guy, Gaius Verres, he was a Roman governor in Sicily, and he was known for being super corrupt.
Mm.
Like, he totally exploited the province for his own personal gain.
Yikes.
I know. Sounds like a character straight out of a movie, right?
Totally. Okay, but so how did we go from this idea of controlled markets to the free market principles that basically run the world today?
Well, it was a slow process, like a gradual shift in economic thinking. And it was driven by some pretty big names, people like David Hume and Adam Smith.
Oh, yeah, Adam Smith, Mr. Invisible Hand.
Exactly. That's the one. That idea that individual self-interest, guided by competition, would actually lead to a more prosperous society overall.
So it's kind of like a chaotic dance floor where everybody's just looking out for themselves, but somehow it all works out.
Pretty much. Yeah, it's kind of a wild idea, but it was revolutionary. And that idea really laid the foundation for like all the modern capitalist economies that we see today.
Fascinating. But okay, so markets evolved, things got more complex.
Definitely. Much more complex.
I guess that means we need some, I don't know, institutions to manage them.
Right, exactly. And that's where our friends, the central banks, come in.
Here's where things get really interesting. The big players, right? The Bank of England, the Federal Reserve, People's Bank of China. Like, how did they get into the picture and what are all the debates about their role in the market?
Right, so central banks, they kind of emerged as these key players, especially after like all the chaos of the Great Depression in the 1930s. They got the power to control interest rates, to manage the money supply, and act as like the lender of last resort if things really hit the fan.
So they're like the referees, trying to keep the game fair and make sure the whole system doesn't just, implode.
Yeah, I like that. But their role has been changing a lot, constantly evolving. And there's always this big debate about how they should actually do their job. Like one of the big arguments is this whole thing about fixed versus floating exchange rates.
Yeah. Fixed versus floating. I feel like I remember that from Econ 101. But I need a refresher. What's at stake here? Why does it matter?
Okay, so with fixed exchange rates, it's like a country's currency is it's pegged to another currency, like the US dollar or even gold. This was really common in the like mid 20th century. And the idea was to, create stability, make things predictable for international trade, for investment, so everybody knows what to expect.
Makes sense. But there's got to be a downside, right? There's always a catch.
Right. So the problem is, with fixed exchange rates, countries can't really adjust to changes in their own economies. Like, what if a country's economy weakens, but their currency is still tied to a really strong currency? Their exports become way less competitive. It can cause all sorts of problems.
Oh, I see. So floating exchange rates give more flexibility.
Exactly. With floating rates, the value of a currency goes up and down based on market forces, like supply and demand.
Ah, the invisible hand at work again.
Exactly. It gives countries more control over their own monetary policy, but it also makes the whole system more volatile. Things can change really quickly.
And we all know volatility can be, well, a recipe for disaster,
Yeah.
especially in today's world where all the markets are so connected.
You're telling me. The book actually spends a lot of time on the challenges that come with liberalization and globalization, that increasing flow of money and trade across borders.
Right.
It asks some really important questions um, about trade imbalances, especially with China's growing trade surplus back then.
Okay, let's dig into that. Why was China's trade surplus a concern for, the global financial system?
Well, so when a country has a big trade surplus, that means they're exporting way more than they're importing. And that can cause tensions, right? Other countries might feel like they need to devalue their own currencies just to compete. It can mess with global capital flows, too.
So it's like, it's got to be balanced, right? Too much on one side throws the whole thing off.
Yeah, it's a delicate balance for sure. And those imbalances, they can play a huge role in financial crises. The Asian financial crisis of 1997-98 is a perfect example of how quickly things can go south.
Oh yeah, things went bad there. What exactly happened there and how did it impact countries like Thailand and South Korea?
Well, leading up to the crisis, a lot of Asian economies, like
Yeah.
Thailand and South Korea, they attracted a ton of foreign investment, and they pegged their currencies to the U.S. dollar.
So when the US dollar got stronger.
Their exports became way less competitive, and all that foreign capital started flowing out.
Oh, I see.
And that caused their currencies to, crash. And then, boom, financial meltdown.
Ouch. Yeah, it's a pretty stark reminder of how fragile things are, especially in a globalized world, right?
It is.
Yes.
And, this leads us to another really important idea in the book, this concept of financialization and how it affects market volatility.
Financialization. That sounds kind of intimidating. What does it actually mean?
Basically, it's about how finance is becoming more and more dominant in the global economy. The growth of all these financial institutions, markets, and these super complex financial instruments.
Sounds like we're entering high stakes Wall Street gambling territory.
Well, there's definitely an element of that. These instruments, they can be used to manage risk, that's true, but they can also be used for speculation.
Yeah.
Which, that can amplify profits, but it can also amplify losses. And when speculation gets out of control, that's when you get market bubbles. That's when you get crises.
And we can't forget about the dot-com frenzy. How does that fit into the picture?
Right. So the dot-com bubble is the perfect example of how this financialization thing combined with, market psychology, speculation, it can create a perfect storm. So you had this rapid growth of the internet, and then you had all this investment pouring into tech companies.
It was like everybody thought the internet was just going to magically make everyone rich.
Right. And valuations went through the roof. Easy access to capital, the fear of missing out. Everybody wanted a piece of the action. But then the bubble burst, right?
Yeah.
And it wiped out trillions of dollars.
Yeah, a lot of people learned some hard lessons there.
They did.
And some companies really became symbols of the excesses of that whole era. The book mentions Enron.
Oh, yeah. Enron and WorldCom. They were like the poster children for corporate fraud. They were a cook in the books, misleading investors, and their collapse, it really shook people's confidence. It showed how important regulation is, right? Like corporate governance, oversight, all that stuff.
So the dot-com bubble was like this wake-up call, this reminder that, hey, speculation can get out of control and we need transparency, accountability,
Exactly. And also raise these big questions about how do you even regulate these markets that are changing so fast, especially in the digital age?
It was early days for the internet back then.
Right. It was the Wild West out there.
It feels like we've been on a whirlwind tour of financial history. It's like technology really plays this huge role in shaping this ever-changing landscape. Our source material, it hints at some potential disruptors in the future, things like digital currencies. But before we get ahead of ourselves, can we maybe rewind a little bit and talk about what the author calls the new economy?
Yeah, let's do that.
The new economy was like this buzzword back in the late 90s. It was all about the excitement, the optimism surrounding the internet and how it's going to change everything, like revolutionize business. It was really tied to the dot-com bubble, right? All those investors pouring money into these internet startups, thinking that they'd struck gold.
It was the future.
So what was so different about this quote-unquote new economy? What made it seem so revolutionary?
Well, you had these rapid tech advancements, especially in computing and communication, right? The internet made information flow faster. It cut down on transaction costs, and it created all these new business models that just weren't possible before, like overnight.
So it wasn't just about the internet itself, but like how it changed everything else.
Right, exactly. There was this feeling that all the old industries were being disrupted and these new industries were popping up like every day. E-commerce, online advertising, software, all that stuff. It felt like a new era was starting and everybody wanted to be a part of it.
I bet. Must have been both thrilling and terrifying at the same time, right?
Right.
Especially with the crash looming on the horizon.
Oh yeah, high risk, high reward. But the book actually points to a key factor that influenced both the rise and fall of the, quote, new economy.
Okay, what's that?
Globalization.
Ah, globalization. We've talked about that before. But how did it specifically play into the whole new economy thing?
Well, globalization basically allowed businesses to reach a much wider audience and tap into these new markets. And that fueled even more investment and growth. But it also made economies way more connected, way more dependent on each other.
It's like a global web, right? If you tug on one strand, the whole thing shakes.
Yeah, that's a great way to put it. And that interconnectedness was a big part of how the dot-com crash played out. When the bubble burst in the U.S., it sent shockwaves through markets around the world.
It's true. No one's really immune to those global forces. So what happened after the dot-com crash? Like, how did the new economy narrative change? Did people just go back to the old ways?
Not really, but there was definitely a period of, I don't know, like a reality check.
Yeah.
All the excesses of the bubble were exposed, and people started realizing, maybe the new economy wasn't as revolutionary as they thought.
A dose of realism.
Yeah, for sure. Investors got more cautious, valuations came back down to earth, and there was more focus on profitability and sustainability. Building businesses with solid foundations, not just hype.
It's like a shift from a speculative mindset to a more practical one. But the internet didn't just vanish.
No way. The internet just kept evolving, maturing. It became what we know it as today. But the crash definitely served as a reminder.
Of what?
That even the most transformative technologies are subject to, the laws of the market.
And that irrational exuberance can have some pretty painful consequences.
You got it.
A valuable lesson, no doubt. It feels like we're starting to see a recurring theme here. Like, markets evolve, they get disrupted, sometimes they get way ahead of themselves, and then boom, correction time. The dot-com bubble, the Asian financial crisis, all of that. It seems to point to a certain kind of, cyclical nature of the financial system. Is this something that's been observed throughout history?
Oh, absolutely. The book talks about this idea of like a cyclical nature of financial markets. You see these periods of optimism and growth, and then, they're followed by pessimism and contraction.
Yeah.
It's a pattern as old as markets themselves.
So it's like a financial pendulum swinging back and forth between boom and bust.
Yeah, that's a great way to think about it. And you can see this pattern in all sorts of historical examples, from the tulip mania back in the 17th century to the more recent housing bubble in the 2000s.
But why does this happen? Is it just human nature? Or are there, like, deeper economic forces at play here?
It's a bit of both, honestly. A complex mix of psychological and economic factors. So you've got things like herd behavior, the fear of missing out, those psychological things that can really drive these speculative bubbles.
So basically, people get caught up in the hype, and they start making decisions based on emotion rather than, logic and facts.
Right. Then on the economic side, you've got things like credit cycles, loose monetary policy. That kind of creates an environment where bubbles are more likely to form.
It's tempting, right? Easy money. But it can also lead to some serious instability down the line.
Exactly. When credit is easy to get, people borrow more, invest more, and that drives up asset prices. But then the credit cycle turns. Interest rates go up, and boom, the bubble bursts.
It's like a game of musical chairs. As long as the music is playing, everybody's happy. But when the music stops...
somebody's left standing without a chair.
Exactly. So understanding these cycles is pretty crucial for investors and, policymakers.
Absolutely. It's all about managing risk, making smart decisions, understanding the bigger picture.
It sounds like this constant dance between risk and reward, exuberance and caution. Are there ways to, I don't know, to predict these cycles or to at least maybe soften the blow when they happen?
Well, economists have been trying to figure that out forever. There's no magic formula, no crystal ball, but there are definitely some warning signs, some indicators that can point to potential problems.
So it's like being a financial detective looking for clues.
Right. One big clue is something called leverage. That's when people or institutions take on too much debt.
So too much debt basically magnifies the losses if things go wrong.
Exactly. Another big one is asset price bubbles. That's when the price of something like stocks or real estate, it goes way beyond what it's actually worth.
Like blowing up a bubble with, too much air until it pops.
Yeah, that's a good analogy.
Yeah.
And this is where policymakers and regulators come in. They need to put in place sound economic policies, monitor those financial institutions, and try to prevent excessive leverage and these asset bubbles.
It's that balancing act again, right? Encouraging growth while putting in those safeguards to keep the system from going haywire.
Exactly. And this is where the whole debate about government intervention gets really interesting. Some people say markets should just be left alone to self-correct. Others say the government needs to step in.
It's a complex issue. No easy answers. But understanding these cyclical patterns, understanding the forces that drive them, that's essential for anyone who wants to navigate the financial world. Now, the book mentions this thing called the Washington Consensus, which I guess it was pretty influential in shaping global economic policy back in the late 20th century. Can we break that down? Like, what is this consensus and how did it come about?
Sure. So the Washington Consensus is basically a set of economic policy recommendations that became really popular in the 80s and 90s.
Okay.
And it was heavily influenced by institutions based in, you guessed it, Washington, D.C., like the International Monetary Fund, the World Bank, the U.S. Treasury Department.
So it's like a made in America approach to global economics.
Well, it definitely reflected American economic thinking at the time. The core ideas were, fiscal discipline, privatization, deregulation, trade liberalization, and financial market liberalization.
A whole lot of liberalization. Sounds like the focus was on free markets and shrinking the role of government.
That's right. The Washington Consensus was all about promoting economic growth and development, especially in developing countries. But it also had its fair share of critics.
Okay, let's hear the criticisms. What were some of the concerns people raised about this Washington Consensus?
Well, some people argued that it was like a one-size-fits-all approach. Like, it didn't really consider the specific circumstances of different countries.
So trying to fit a square peg in a round hole.
Exactly. They also said it focused too much on economic growth and not enough on things like social equity or environmental sustainability.
So, like, the human and environmental costs were kind of ignored.
Yeah, and there was concern that those policies were actually leading to more inequality, more social unrest, and even environmental damage.
Right, and we've seen how that deregulation and financial liberalization can lead to instability. Like, wasn't the Asian financial crisis partly blamed on that?
That's right. The rapid liberalization of financial markets in that region definitely made them more vulnerable.
A cautionary tale, for sure. So how did this Washington Consensus change? Did it adapt in the face of all this criticism?
Well, by the late 90s, early 2000s, it had definitely lost some of its shine.
The limitations were starting to show.
Right. People started seeing the unintended consequences. There was a growing push for, a more nuanced approach to economic development, like something that takes into account the specific context of each country.
It sounds like there was never really a true consensus on this, was there? Like, weren't there always different perspectives and different schools of thought?
Yeah, you're right. Even when the Washington Consensus was at its peak, there were always people pushing back, offering different ideas.
So, like, different factions in the world of economics, each with their own theories and prescriptions for how things should be run.
Yeah, exactly. You had economists who emphasized the importance of government intervention in promoting development. They said that developing countries need things like industrial policies, infrastructure investment, and social safety nets.
So basically, a more active role for government in shaping the economy.
Right. They challenged the idea that free markets could solve all the problems. They pointed to countries like Japan and South Korea, which had used government intervention to boost their economies.
It sounds like they were saying, hey, there's no one-size-fits-all solution.
Yeah, exactly. Each country has its own unique challenges and opportunities.
Now, let's connect this back to our main focus. How did these debates about globalization, liberalization, and the role of government actually play into those dynamics of financial crises and market volatility.
Well, we've seen how globalization and liberalization have made the financial system way more interconnected and complex.
Right.
And that's brought a lot of opportunities, but it's also increased the risk of what we call financial contagion.
Contagion.
Yeah, it's like how financial shocks can spread rapidly from one country to another, kind of like a virus.
So interconnectedness is a double-edged sword. It can be both a strength and a weakness.
Exactly.
Yeah.
And there's still a lot of debate about what role governments should play in all this. Some say we need more international cooperation, more regulation to prevent these crises. Others say that would just stifle innovation and growth.
It's a tough question. No easy answers there. Now, the book really dives into the dot-com bubble, right?
It does.
Can we take a closer look at what caused that bubble and what lessons we can learn from it?
Sure. So the dot-com bubble, it was all about this rapid growth in the value of internet and tech companies, right?
Right.
Fueled by speculation, easy access to capital, a lot of familiar ingredients.
It was a time when people were throwing around phrases like internet revolution and new paradigm, like it was going out of style.
Yeah. Like I said, it felt like the future was happening right then and there.
So what were the specific things that created this environment of, well, exuberance? Maybe even irrational exuberance.
Well, one big factor was the speed of technological innovation back in the 90s. The internet was changing everything, how we communicate, how we access information, how we do business. It was truly disruptive. And a lot of people believed that it would completely reshape the economy.
It was a time of genuine excitement, but maybe with a little bit of irrationality mixed in.
Definitely. Investors were pouring money into these internet startups, many of which didn't even have any revenue. They were just burning through cash.
Burning through cash, but going up in valuation.
Yeah. And it was all driven by this fear of missing out and the belief that, the old rules of valuation didn't apply anymore.
It's amazing how much psychology influences markets.
Oh, it's huge. Herd behavior, FOMO, confirmation bias, it all played a role in the dot-com frenzy.
So it's not just about the numbers, it's also about the stories we tell ourselves about the future.
That's a great way to put it. The dot-com bubble was fueled by this powerful narrative of a new economy, a future where the internet would change everything and create incredible wealth.
But then reality set in.
Unfortunately, yeah.
So what popped the bubble? Was there a specific event, or was it just a gradual loss of, I don't know, faith?
It was a few things, actually. First, interest rates started going up in the late 90s.
Oh.
Yeah, so it became more expensive to borrow money and invest. That put downward pressure on those sky-high valuations.
So that easy money dried up.
Pretty much.
Yeah.
Then you had some of those big dot-com companies. They started missing their earnings targets. Some even went bankrupt.
The cracks were starting to show.
Exactly. And then people started realizing that a lot of these dot-com companies were just, well, overvalued.
So the rose-colored glasses came off and people realized the internet wasn't a magic money machine.
Right. As investors lost confidence, they started selling their shares, and that caused prices to plummet. The bubble burst, and trillions of dollars vanished.
Another stark reminder of how those market cycles work. So what are the key takeaways from the dot-com bubble? What should we learn from that whole experience?
Well, I think it's a reminder that even in times of rapid innovation, when the economy is transforming, the basic principles of valuation and risk management, they still matter.
So don't get swept up in the hype.
Exactly. It's important to separate the hype from the reality, to look at the fundamentals, and to make investment decisions based on, solid analysis, not emotion.
And to recognize those psychological factors at play, the herd behavior, the FOMO.
Absolutely. Be aware of those biases and make sure your investment decisions are based on a realistic assessment of risk and reward.
The dot-com bubble was definitely a cautionary tale, but it also shows the power of technology, right? Like the ability to disrupt industries and create these new opportunities.
For sure. The internet has revolutionized the way we live, but it's important to manage those risks that come with it.
Risk. It seems like that's the underlying theme of all these conversations. It's like risk is just baked into the financial world, right?
It is.
And figuring out how to manage it, how to mitigate it, that's essential for everyone. Individuals, institutions, policymakers, everyone.
You got it.
Speaking of risk, our source material mentions something called the Greenspan put. It's a bit of Wall Street jargon, so can you break that down for us? And why is it relevant to our conversation about financial markets and crises?
Okay, so the Greenspan put refers to this tendency that people perceived in Alan Greenspan. He was the Federal Reserve Chairman back then.
Right.
And the perception was that he would always lower interest rates or, take other actions to kind of prop up the stock market and prevent or soften those financial crises. It's called a put because in finance, a put option gives you the right, but not the obligation, to sell something at a specific price.
So it's like an insurance policy. Like investors felt like Greenspan had their back, that he'd always come to the rescue if things got bad.
Yeah, that's the basic idea. And this term, it really became popular in the 90s when Greenspan was in charge. And, it was a time of amazing growth and stability, so it made sense that people felt that way.
But giving people that sense of security, that maybe leads to some complacency, doesn't it? Like if you know someone's always going to bail you out, you might take more risks.
That's right. Some people argue that this Greenspan put, or at least the perception of it, actually encouraged investors to be a little too reckless. Like, why worry about risk if you know the Fed will always come to the rescue?
It's like a kid who keeps misbehaving because they know their parents will always forgive them.
Exactly. And that brings up the problem of moral hazard. When people don't face the consequences of their actions, they're more likely to make bad decisions.
Right, so even well-intentioned policies can backfire sometimes.
Absolutely. And the debate about the Greenspan put and the role of central banks in all of this, it's still going on today.
It's that tricky balance again.
Mhm.
Trying to create stability without creating this sense of, I don't know, invincibility, like making sure people are aware of the risks, even as you're trying to protect the system.
Right. It's a tough job.
Now, the book mentions a lot of historical examples of these bubbles and crises, some of them going way back. Do you think we could maybe take a quick tour through history and look at some of these? I think it would really help us understand these patterns, these lessons that we keep talking about.
I'd love to. I think looking back is the best way to understand where we are and where we might be going.
Got it. Awesome. So where should we start?
Well, let's go way back to one of the most famous bubbles of all time, the tulip mania.
Wait, tulips? Like the flowers?
The very same. It happened in the Netherlands back in the 17th century during the Dutch Golden Age.
Okay, I'm intrigued. So how did a flower become the center of a financial bubble?
Well, tulips were a new thing back then. They had just been introduced to Europe from Turkey, and they were seen as these exotic, beautiful, luxurious flowers. And because they were scarce, the demand was high.
So people genuinely admired them.
They did. But then as prices went up, the speculation started. People were buying these tulip bulbs, not to plant them, but to sell them for a profit.
So it was all about buying low and selling high, like a game of hot potato.
Exactly. It became completely detached from the actual value of the tulips. It was pure speculation.
And we know how the story ends. All bubbles burst. What happened with the tulip mania?
Well, in 1637, the bottom fell out, prices crashed, and a lot of people were ruined.
Wow. So it's a classic example of how speculation and this herd mentality can drive prices up way beyond what something is actually worth.
It is. And it reminds us that anything can become the object of speculation, even something as seemingly simple as a flower.
Are there any other historical examples that can teach us about this?
Oh, definitely. There's the South Sea Bubble. That one happened in England in the early 18th century.
Okay, the South Sea Bubble. What was that all about?
So there was this British company, the South Sea Company, and they were granted this monopoly on trade with South America.
Sounds promising.
It did, but it was mostly based on speculation, rumors of, riches in South America.
So people got caught up in the hype again, hoping to strike it rich.
Exactly. And the company's share price, it just went through the roof.
Yeah.
But the profits, they never really materialized.
Oh, boy.
And then in 1720, the bubble burst, causing this huge financial panic. People were ruined.
Another bubble, another crash. It's like a broken record.
I know, right? But there's a reason we keep talking about these historical examples. They teach us valuable lessons.
Like what?
Well, the South Sea Bubble shows how dangerous it can be when people invest based on rumors and speculation, without really understanding the underlying business or the risks involved.
So do your research.
Always do your research.
It seems like each one of these bubbles and crashes leaves its mark on history, right? Shaping regulations, influencing economic thinking. Like, we learn from our mistakes, or at least we try to.
You got it. These historical examples, they teach us about those recurring patterns and about the importance of managing risk, regulating speculation, and maintaining investor confidence. That's key.
And it's amazing how we can see these same patterns playing out over centuries. Even though the technologies change, the markets change, human nature seems to stay the same.
You're absolutely right. Human psychology, herd behavior, the desire to get rich quick. Those things are timeless, unfortunately.
Okay, let's fast forward a bit. Our source material mentions the Asian financial crisis of 1997-98, another modern example of this market volatility and, what was it called? Contagion.
Contagion, yeah. It's a good term for it. It's like a financial virus that can spread rapidly.
Right. So remind us, what happened during that crisis and what are the key lessons there?
So the Asian financial crisis, it started in Thailand in 97, and it spread really quickly to other Southeast Asian countries like Indonesia, South Korea, Malaysia.
And I'm guessing that globalization and interconnectedness that we've been talking about, that played a role.
Oh, absolutely.
Oh.
The crisis was triggered by a sudden loss of confidence in the Thai currency, the baht, which led to a rapid depreciation, and then foreign capital started flowing out, like a lot of it.
When that happened?
It creates a domino effect.
Right. Investors get spooked, they lose confidence in other countries in the region and start pulling their money out.
Exactly. And it led to some pretty severe economic contractions, bank failures, even social unrest.
Wow, so beyond the financial impacts, there were social and political consequences as well?
Yeah. Unfortunately, that's often the case with these major crises. They tend to expose those underlying weaknesses in the system, and those weaknesses aren't always just economic.
So, looking back, what were some of the root causes of this crisis? Was it just like a panic in the market, or were there some deeper issues at play?
Well, there were definitely some deeper vulnerabilities.
Hmm.
These economies had high levels of private debt. They had fixed exchange rates, which we talked about earlier, and there were some weaknesses in their financial regulations.
So, leverage, speculation, regulatory gaps, some familiar themes.
Yeah, we've seen those before. And the Asian financial crisis really highlighted the importance of sound macroeconomic policies, prudent financial regulation, and the need for countries to work together to prevent and manage these types of crises.
It's a reminder of how quickly things can unravel and how devastating the consequences can be, not just for, investors, but for everyday people.
Absolutely. And the crisis also led to some soul-searching about that Washington consensus we talked about earlier.
Right.
A lot of economists started to question those policies of rapid financial liberalization, that one-size-fits-all approach to development.
Like maybe there's no magic bullet.
Right, exactly.
Now, the book focuses a lot on the dot-com bubble, but it also kind of hints at this other bubble that was forming around the same time, the housing bubble.
Oh, yeah, that one was a big one.
Can we touch on that briefly? How did that bubble form, and how did it lead to the global financial crisis of 2008?
So, the housing bubble, it was all about this rapid increase in house prices in the early 2000s, driven by low interest rates, easy credit, and, of course, speculation.
Sounds familiar, right? Easy money, people thinking prices will just keep going up forever.
Yeah, the classic bubble recipe. And as house prices went up, people took out these huge mortgages, a lot of them with those adjustable interest rates.
Oh, those are dangerous.
They can be. And then those mortgages, they got bundled together and sold off as these complex financial instruments, mortgage-backed securities.
So those mortgages, they basically became these ticking time bombs being traded around the financial system.
Pretty much. And the problem was that when interest rates started to rise, a lot of people couldn't afford their mortgage payments anymore.
Uh-oh.
And that led to a wave of defaults and foreclosures, which caused the value of those mortgage-backed securities to plummet.
And of course, those securities were held by banks and financial institutions all over the world.
Right. It was a global problem. And the collapse of the housing market, it basically triggered a chain reaction throughout the entire financial system. And that led to the worst financial crisis since the Great Depression.
Wow. Another example of how interconnected everything is and how fragile the system can be.
Yeah, it really showed the importance of responsible lending practices, solid financial regulations, and, the need for global cooperation. Because these crises, they don't respect borders.
It seems like we've covered a lot of ground today. We talked about the cyclical nature of markets, the things that drive these bubbles and crises, and all those lessons we can learn from history. The financial world, it's complex, it's constantly changing, and understanding how it all works is crucial for everyone.
I agree. It can feel overwhelming sometimes, but I think the most important thing to remember is that the financial world isn't some static system governed by these set-in-stone laws. It's a dynamic system driven by human behavior, by technology, by government policies, and by all these global events.
So many moving parts.
Exactly. And that's why understanding those fundamental drivers, human psychology, government policies, technological innovation, is essential. Those things, They're the keys to navigating the financial world, no matter what new challenges or opportunities pop up.
And speaking of new challenges and opportunities, we've been talking a lot about digital currencies and how they have the potential to really shake things up. But it's not just about Bitcoin anymore, is it? There's a whole universe of blockchain technology and applications that are popping up, from DeFi to NFTs. It's a lot to keep track of.
It really is, and it's all moving so fast. Like with DeFi, for example, they're trying to recreate those traditional financial services like lending and borrowing, but on the blockchain. No banks, no intermediaries. And then you've got NFTs, which are changing how we think about owning and trading digital assets, from art and music to like virtual real estate. It's pretty wild.
It feels like we're on the verge of a major shift in how we think about money, value, ownership. But like we've seen over and over, with every new frontier comes this mix of excitement, opportunity, and, let's be honest, risk.
For sure. We're in uncharted territory. The possibilities are incredible, but so are the potential pitfalls.
So how do we navigate this? How do we figure out which trends are worth embracing, which ones to be cautious about? It's a lot to process.
I think the key is to stay informed, to keep learning, and to be critical thinkers. Don't just jump on the bandwagon because everybody else is doing it. Do your research, understand the technology, and be aware of those potential risks.
Like we said before, knowledge is power, especially in the financial world.
Couldn't agree more.
And that brings us back to Ding Yifan's book. Even though it doesn't talk specifically about blockchain or NFTs, it gives us this really valuable framework for understanding those underlying dynamics of financial markets. And it reminds us that history tends to repeat itself in one way or another.
Yeah, it's fascinating how relevant this book still is today, considering it was published before all these technologies even existed.
It's a testament to, understanding those fundamental principles that drive markets, that those things, they transcend any specific technology or trend.
Exactly. And I think those are the things that we should focus on as we move forward into this, increasingly complex and uncertain financial landscape.
Well said. I think that's a perfect note to end on. Thanks for joining me on this deep dive. It's been a fascinating journey.
The pleasure's all mine. It's always great to chat about this stuff.
And to our listeners, remember, stay curious, stay informed, and keep exploring. Until next time.
Yeah, it is amazing how a book written like over 20 years ago can still be so relevant, to what's happening today.
I know.
It's like Ding Yifan, he understood those forces that drive markets. Even as technology and globalization, they just accelerate everything.
He did. And those insights, the boom and bust cycles, that human psychology, the way governments and markets kind of push and pull on each other. I mean, those are the key things we've been talking about. And those are what help you navigate the financial world, no matter what new crazy thing comes along. Exactly. And speaking of crazy new things, we've been talking a lot about digital currencies and how they could really change, everything about finance.
Yeah.
But let's be real, it's not just Bitcoin anymore. It's way bigger than that. It's like this whole ecosystem of blockchain technologies.
Oh, yeah.
DeFi, NFTs, all these things that, I gotta be honest, are still a little hard to wrap my head around.
Yeah, it's a lot. And it's all moving so fast. I mean, DeFi is trying to, recreate all those traditional financial services, like lending and borrowing, but without the banks.
It's crazy.
And NFTs are creating these whole new ways to own and trade digital stuff like art, music, even virtual real estate.
It really feels like we're on the edge of a massive change in how we think about money, about value, about ownership.
Right.
But I mean, like we've seen throughout history, every new frontier comes with risks.
Definitely. Big risks.
So are these innovations going to make the financial system better, more inclusive, more efficient? Or is it just going to be, more speculation, more fraud, more instability?
I think that's the big question. Nobody really knows for sure.
That's what makes it so fascinating. And a little bit scary too, honestly. We're living through this experiment and it's hard to know what's going to happen. It's hard to know as an individual what to do, what to pay attention to, what to be careful about.
Yeah, I get it. It can feel overwhelming. But I think the most important thing is to stay informed. Keep learning. Be like a critical thinker. Don't just follow the crowd.
Right.
Do your own research, understand the tech, and always be aware of the risks.
Like we said before, knowledge is power,
Yeah,
especially when it comes to your money.
exactly.
And that brings us back to Ding Yifan's book. Even though it doesn't talk about, blockchain or NFTs specifically, it gives us the tools to think about this stuff, right? To understand how markets work.
It does.
It reminds us that, well, some things never really change, whether it's tulip bulbs in the 1600s or internet stocks in the 90s or Bitcoin today.
Those underlying principles, yeah.
Yeah.
Human psychology, government policies, technological change.
Those are the constants, and those are what we need to understand if we're going to navigate this crazy financial world.
Well said.
Well, I think that's a great place to wrap things up. Thanks for joining me on this deep dive. It's been a real eye-opener.
My pleasure. Always a good time.
And to our listeners, thanks for tuning in. Stay curious, stay informed, and as always, happy diving.